Hey everyone, and welcome back for another deep dive. Things are getting a little strategic today. Um,
Oh, yeah.
yeah, we're going to be talking about smart decision making when markets are, well, they're going a little wild.
Definitely been seeing that.
Yeah, kind of like what we've been seeing in 2024.
Definitely a theme these days, volatility.
Right. So to help us navigate all this, our source material is an article titled, Answer These Four Questions Before Entering Turbulent Markets. It was published on November 4th, 2024.
Okay.
And we're going to be using it to arm you with the right questions to ask before you jump into any big market move, especially with all this upward action we've been seeing lately.
Yeah, those upward trends can be exciting, but, excitement isn't always the best advisor when it comes to invest in.
Very true. Speaking of which, let's talk about the FOMO,
Oh, the fear of missing out.
the fear of missing out. This article gets right to the heart of it.
It's huge. FOMO is a huge driver in market decisions, especially for newer traders.
Well, absolutely. I've definitely felt that pang of regret, seeing others profit while I was sitting on the sidelines,
No, of course, yeah.
wondering, should I have gotten in on that? Have you ever felt that?
Absolutely, everyone has.
Yeah.
But the article emphasizes, missing out on past gains shouldn't be the reason that you jump in now.
Right.
Remember 2023 when the crypto market, oh man, went haywire?
Oh, yeah.
People piled in at the peak only to see it. TFT come crashing down.
Oof. Yeah.
So past performance is never a guarantee.
Good point. So instead of FOMO, the article suggests analyzing why you missed a move. Like, were there signals that you overlooked? Were there trends you just didn't recognize early enough?
Exactly. That's how you learn and refine your strategy,
Yeah.
turn those missed opportunities into valuable lessons.
Ooh, I like that. Okay, already seeing things a little differently. All right, so moving on, the next big question from the article, it uses this great analogy about a roaring fire. Market trends need fuel to keep burning.
Yeah.
What was hot yesterday might be cooling down today.
Right.
So how do we assess that?
Well, the article drills down on that with three key questions.
Okay.
The first is, has the overall market sentiment or the risk appetite, have those shifted since that big move started?
Mm-hmm.
Think of it this way. Early in a trend, everyone's optimistic, willing to take on more risk.
Sure.
But as a trend matures, that can change.
Makes sense, yeah.
Like what if there's sudden news about increased regulation or a major economic slowdown?
Oh, yeah, that would dampen the mood.
Yeah, exactly. It can be like throwing a bucket of water on that roaring fire.
Right, yeah.
So the second question the article asks is, have any new factors come into play that could change things? Are there new regulations, unexpected disruptions, even things like trade-in limits being imposed that can really throw a wrench in the works?
Wow, yeah, it can totally change the theme. And the third question, it focuses on the signs of fatigue in the market itself, right?
Yes.
Things like technical indicators, price candles, trade and volume. I think some of our listeners might benefit from a quick explanation of those.
Of course. Let's take the Relative Strength Index, or RSI, for example. It's a momentum indicator that measures the magnitude of recent price changes to evaluate overbought or oversold conditions in the price of a stock or other asset.
Okay, so if the RSI is above 70, it suggests that that asset might be overbought, and then if it's below 30, it could be oversold. So it's like a gauge for how hot or cold the market is for that particular asset.
That's a great way to put it.
Okay, cool. What about price candles?
So price candles, those are a visual representation of price movement over a specific time frame, and their shapes and colors can actually tell us a lot about the buying and selling pressure.
Oh, interesting. So like, for example, a long green candle suggests strong buy-in pressure,
Yeah.
while a long red candle would suggest strong sell-in pressure.
Exactly. And then there's trading volume,
Okay.
which refers to the number of shares or contracts traded over a given time. Increasing volume often confirms a strong trend, while decline in volume can signal wane in interest.
Okay, so by analyzing all these factors, we can get a better sense of whether a trend still have legs or if it's, running out of steam.
Exactly.
But let's face it, even if we do all this analysis and we feel confident about a trend, there's always that element of risk, right?
Absolutely. Risk management is non-negotiable,
Right.
even in a strong upward trend. Remember, markets are inherently unpredictable.
It's like that old saying,
Don't count your chickens before they hatch.
that's the one.
Exactly. And the article is very clear about this. Setting stop-loss orders, those are your safety nets, can be very difficult in a volatile market. Prices are bouncing around, which can trigger your stop-loss too early. But here's the catch. You should never trade without a stop-loss order.
Right, but isn't there a chance that a stop-loss order could get triggered prematurely in a volatile market,
Hmm.
causing us to miss out on potential gains if the price bounces back? How do you balance that?
That's a great question, and it's a real dilemma. The key is to find a balance between protecting yourself from significant losses and allowing the trade room to breathe. One strategy the article recommends is starting with smaller trade sizes and then gradually increasing your position as the trade moves in your favor.
So it's kind of like dipping your toes in the water before diving in head first.
Yeah,
That way, if the trade goes against you, you're not risking as much capital, but you're still positioned to capitalize if it goes your way.
precisely. This approach helps manage both the FOMO and potential losses, which is especially important in turbulent markets.
I like that strategy is all about being smart and calculated, not just emotional. Okay, speaking of smart moves, the article's final question is about entry points. They use this brilliant analogy, imagine the chaos of Black Friday shopping.
Oh, yeah.
Sometimes waiting for that initial frenzy to die down can get you a much better deal.
It's the same in the markets.
Oh, interesting.
The article challenges us to think about whether we could get a better price by being patient, strategic. Are there opportunities to enter during a price correction? Even in an upward trend, there are almost always little dips or pullbacks.
So instead of chasing the price when it's, skyrocketing,
Right.
we could potentially wait for one of those dips and snag a better entry point. It's like waiting for a sale.
You got it. You're still participating in the overall upward move, but you're potentially getting in at a more favorable price. And then there's the idea of psychological levels.
Oh, I have to admit, that one always makes my head spin a little bit. Can you break it down for us?
Think of it like this. Imagine a stock that's been trading below $100 for a long time.
Okay.
That $100 mark becomes a psychological barrier,
Huh.
a level that traders fixate on.
Okay.
Once it breaks above $100, it can trigger a surge of buy-in as those traders who were hesitant suddenly jump in. Remember what happened with Tesla back in 2021 when it broke through $1,000?
Oh, yeah.
It was like a dam break-in.
Yeah, wow, that's a great example. So these psychological levels can act as support or resistance zones, and watching how the price behaves around these levels can give you valuable clues about future movements.
Exactly. It's like understanding the psychology of the crowd and anticipating their reactions.
Okay, so we've covered a lot in this first part.
We have.
We talked about FOMO, how to analyze the driving forces behind a trend, the importance of risk management, even getting strategic about entry points with that sniper entry concept.
It's all about asking the right questions, being critical, and not getting swept up in the hype.
Very well said. But here's a question for you. The article focuses on entering an existing trend, but what about spotting a trend before it takes off? Isn't that where the real opportunity lies?
You're absolutely right, and that's what we'll dive into next.
Ooh, I can't wait.
Yeah, spotting those early trends, that's where things get really interesting. It's like being a detective looking for clues.
I like that. So how do we become market detectives? What kind of clues should we be looking for?
Remember a while back when we were talking about sentiment analysis? That's one powerful tool in our detective kit.
Oh, yeah, tracking news and social media, getting a heads up on emerging trends.
Exactly. It's like getting a sneak peek into the collective psyche of the market.
Right.
Are people buzzing about a certain sector, worried about inflation? Those shifts in sentiment can often precede big price moves.
Okay, but how do you actually do sentiment analysis? Is it just scrolling through Twitter all day?
Well, sometimes it can be that simple,
Really?
but there are also more sophisticated tools.
Oh.
Some traders use algorithms to scan massive amounts of text, looking for patterns and keywords that suggest either positive or negative sentiment.
Wow, that sounds intense. But I guess it makes sense in this age of information overload.
It's not just about the volume of information, though. It's also about the source.
Right.
Who's saying what? Are they respected voices in the market or just noise?
So we got to be careful about where we get our information from and how we interpret it.
Exactly. Developing a critical eye is essential. Question those assumptions. Always cross-reference your information to make sure it's accurate.
All right, so to recap, we've got these 4 questions from the article to help us evaluate existing trends, and then we can add sentiment analysis to potentially spot those new trends before they take off.
Yep.
Am I getting that right?
You're spot on. It's all about building a robust toolkit for navigating the market. But of course, we can't forget about the bigger picture.
Oh, you mean the whole concept of market cycles?
The ebb and flow of those financial tides.
I got to be honest, that's one concept that always makes my head spin a little bit.
I understand. Market cycles can be both fascinating and incredibly frustrating. They're powerful if you can ride them correctly, but also notoriously difficult to predict with certainty.
Okay, so back to basics. What exactly are market cycles?
They're essentially recurring patterns of expansion and contraction that economies and financial markets tend to go through.
Hmm.
Think of it like seasons. We have periods of growth and then periods of correction or even recession.
So it's not just about stock prices going up and down, it's about the whole economic ecosystem.
Precisely. And these cycles are influenced by a ton of factors: interest rates, government policies, technological innovations, even global events.
Wow.
They all play a role.
It's like a giant complex puzzle.
Okay.
So if we can understand where we are in a particular cycle, that can give us clues about potential future movements.
Exactly. It's all about recognizing those patterns.
Okay.
One common framework divides a cycle into four main phases.
Okay.
First, you have the accumulation phase, where prices are generally low, sentiment is pretty gloomy, and only the most contrarian investors are buying.
So it's like the calm before the storm.
You could say that.
Okay.
Then comes the markup phase, where prices start rising, sentiment starts to improve, and more investors jump on board as those gains become more obvious.
That sounds like where FOMO really kicks in.
Right. And as that markup phase continues, it can lead to euphoria and even a bubble where prices get detached from fundamentals. We saw that in the dot-com bubble of the late 90s and even in certain parts of the crypto market more recently.
Right.
So everyone's caught up in the excitement thinking it'll go up forever.
Right, but it never does.
Right. Eventually, it leads to the distribution phase where prices start to level off, sentiment turns cautious, and those early investors start taking profits. Then eventually you get to the markdown phase.
Uh-oh, the not so fun part.
Yeah, it's where prices fall, sometimes quite sharply, and fear takes hold.
So the key is recognizing where we are in this cyclical dance and adjusting our strategies accordingly.
Exactly. If we're in the early stages of a bull market, maybe we're more willing to take risks. But as we get closer to the peak of a cycle, it might be time to get more cautious and think about preserving capital, maybe even looking at those more defensive investments.
Those like knowing when to play offense and when to play defense.
That's a great analogy. But here's the catch. Market cycles are rarely textbook perfect. They can vary in length and intensity, and unexpected events can totally disrupt the pattern. Think about the COVID-19 pandemic. That threw everything for a loop.
Yeah, that was a wild card.
Yeah.
So there's always an element of uncertainty and risk involved.
Always. That's why having a well-diversified portfolio is so important. It's about spreading out your risks and not putting all your eggs in one basket.
Right, don't bet the farm on any one thing. Okay, so we talked about these different phases of a market cycle, but how do we know which phase we're actually in right now? Are there clues to help us figure that out?
Great question. While there's no crystal ball, there are some indicators and analytical tools that can give us a sense of where we are on that financial map.
Okay, I'm all ears. Give me those clues.
One of the most important things to look at is economic growth.
Mm-hmm.
Are we in a period of expansion or contraction? Are key economic indicators like GDP, employment, and consumer spending, are those trending up or down? This can tell us a lot about the overall health of the economy and where it might be headed.
So we need to pay attention to those big picture economic reports. Got it. What else?
Interest rates are another critical factor.
Go.
Are central banks raising or lowering rates? This has a huge impact on borrowing costs for businesses and consumers, corporate profits, even investor sentiment.
And let's not forget about inflation. That's been a hot topic lately.
Absolutely. Is inflation rising or falling? Is it under control or is it getting out of hand? High inflation can erode purchasing power, squeeze corporate profits, and lead to even tighter monetary policy from those central banks we were just talking about.
Oof, it seems like there's a lot to keep track of.
There is, but remember, it's not just about stock prices in isolation.
Okay.
It's about understanding how all these different forces, economic growth, interest rates, inflation, work together to shape the market. It's like watching a complex dance where everything's connected.
Okay, I'm starting to get a feel for it.
Yeah.
But how do we measure investor sentiment? Is there a way to track that?
There are a few tools we can use.
Okay.
One is the CBOE Volatility Index, or VIX, often called the Fear Index.
Okay.
It measures the market's expectation of future volatility.
So when the VIX is high, it means people are nervous, expecting big price swings.
Exactly. A high VIX usually means investors are feeling anxious, but when it's low, it suggests a sense of calm, even complacency, like everything's just smooth sailing.
Interesting. So the VIX is like a thermometer for the market's mood.
Mm-hmm.
What else can we use to measure sentiment?
The put-call ratio is another helpful tool.
Okay.
It measures the volume of put options, Those are bets that the market will go down,
Okay,
relative to call options, which are bets that the market will go up.
gotcha. So if the put-call ratio is high, it means more people are betting on a downturn.
Exactly. It suggests that investors are feeling more bearish than bullish. A low ratio would indicate the opposite, more optimism, more bets on the market going up.
Okay, so we've got those big economic indicators, interest rates, inflation, and sentiment metrics like the VIX and the put-call ratio. It sounds like a lot to juggle,
It can be. The key is to focus on the indicators that are most relevant to your investment strategy.
right? Not getting overwhelmed by all the noise. But are these indicators foolproof?
That's a really important point. These are just tools, not crystal balls.
Right.
They can give us valuable insights, but they can't predict the future with 100% certainty.
So it's like having a good map, but you still need to know how to read it and make decisions based on the terrain.
That's a perfect way to put it. It's about balance and analysis with prudence and knowing that sometimes unexpected things happen.
Speaking of unexpected things, I'm curious, can you think of any examples where these indicators gave a misleading signal? Or where the market just didn't behave the way everyone expected?
That's a great question, and it highlights why being a lifelong learner in the markets is so crucial. Let's look back at 2008. Many of the traditional indicators were signaling a slowdown, but very few people, even experts, anticipated the severity of the financial crisis that unfolded.
Right. That was a major turning point.
Yeah.
It really showed that even with all the tools and analysis in the world, there are still these black swan events that can catch everyone off guard.
Exactly. And it reinforces the importance of things like diversification, risk management, and not getting too caught up in the hype or the panic of the moment.
So it's all about having a well-rounded approach and staying grounded no matter what the market throws at us.
Couldn't have said it better myself. So we've covered a lot of ground here. We talked about FOMO, how to analyze market trends, the importance of risk management, and the complexities of those market cycles, even how to get a sense of where we might be within those cycles using various indicators.
Phew. It's been a whirlwind tour, and I think a lot of listeners will walk away with a much deeper understanding of how to navigate these, wild markets. But before we wrap things up entirely, I want to circle back to the article that kind of kicked off this whole conversation.
Yeah.
It emphasized the importance of asking ourselves those 4 key questions before jumping into any big market move.
Those questions are essential for making smart decisions, especially when there's so much volatility and uncertainty.
And they connect beautifully with everything else we've talked about today. It's
Yeah.
all about approaching the market with a critical eye, a well-defined strategy, and a willingness to adapt.
Well summarized. But here's a question for you. Imagine someone's listened to this entire deep dive,
Okay.
and they're feeling inspired to take action, but they're also feeling a bit overwhelmed by all the information. What's one piece of advice you'd give them to get started on the right foot?
Ooh, that's a great question.
Yeah.
I think the most important thing is to remember that investing is a journey, not a destination. There's always something new to learn.
That's great advice. And it highlights the importance of continuous learning and being adaptable because the markets are constantly changing, and so are the tools and strategies we need to navigate them effectively.
Absolutely. And I think another important piece of advice is to start small.
Yeah.
Don't feel like you have to jump in with everything you've got. Dip your toes in the water, experiment with different strategies, see what works for you.
That's a great point. It's much better to start small and gradually build your confidence and experience than to go all in and potentially make costly mistakes.
Right, exactly. And remember, there are tons of resources available to help you learn and grow as an investor. There are books, articles, websites, podcasts like this one.
Don't be afraid to ask questions. There are online forums, communities, even financial advisors who can help you along the way.
Exactly. The key is to be proactive, to seek out knowledge, and to surround yourself with people who can support your growth.
Well said. I think that's a great note to end on. We've covered a lot of ground in this deep dive, and we've equipped our listeners with some valuable tools and insights.
But the learning doesn't stop here. It's up to each of us to take this knowledge and apply it to our own unique investment journeys.
And that's the exciting part, because the markets are a dynamic, ever-evolving landscape, and there are always new opportunities to discover.
So to all our listeners out there, thanks for joining us on this deep dive. Until next time, happy investing.
Wow, it's been an amazing journey exploring all these concepts from, decoding market trends to understanding those big market cycles. There's so much to consider when it comes to, smart investing.
Absolutely. And the learning, It never stops.
Right.
Markets are constantly throwing those new challenges our way.
That's for sure. Speaking of learning, there's one last nugget of wisdom from that article that I want to highlight.
Okay.
It really emphasized patience.
Mm.
Not just patience in waiting for the right entry point, but also patience in letting our investments grow over time.
That's a crucial point, and it brings us to one of the most fundamental principles of wealth creation, compounding.
Okay, I've heard that term thrown around a lot, but to be honest, I'm not sure I fully grasp it. Can you break it down for us?
Imagine a snowball rolling down a hill.
Okay.
As it rolls, it picks up more snow, getting bigger and bigger, and the faster it rolls, the more snow it accumulates. That's compounding in action.
It's the idea that your returns generate more returns, which then generate even more returns.
Well, okay.
It's a snowball effect that can really accelerate your wealth growth over time.
So it's not just about earning a steady return year after year. It's about those returns building upon themselves, creating this like amazing growth cycle.
Exactly. Let's say you invest $1,000
Okay.
and you earn a 10% return in the first year.
Mm-hmm.
That's $100 in profit.
Yeah.
Now, in the second year, you're not just earning 10% on your original $1,000.
Right.
You're also earning 10% on that $100 profit from the previous year. So your returns are compounded and your wealth grows faster and faster over time.
Okay, yeah, that makes sense. But how does compounding work in a turbulent market? It seems like when prices are going up and down all the time, it would be hard to let those returns really build up.
That's where the patience comes in.
Yeah.
When markets are volatile, it's easy to get caught up in the short-term noise,
Yeah.
to panic when prices drop and
Right.
make impulsive decisions. But if you have a solid long-term investment plan, a diversified portfolio, and you believe in the power of compounding, you're more likely to weather those storms and come out ahead in the long run.
So it's almost like riding a wave, you know? You're going to have ups and downs,
Yeah.
but as long as you keep your balance and focus on the horizon, you'll eventually reach your destination.
That's a great analogy. Investing is a marathon, not a sprint. And just like a marathon runner needs endurance and discipline, a successful investor needs patience and a long-term vision.
And a belief in the power of that snowball effect.
Absolutely. Compounding is one of those amazing forces in finance that rewards those who can stay focused and disciplined over time.
Yeah.
It's about delaying gratification and trusting that those small, consistent gains will eventually add up to something truly significant.
I'm inspired. This has been such an eye-opening conversation. We've covered so much ground, from dissected market trends to understanding those bigger cycles, managing risk, even harnessing the power of compounding.
It's been a pleasure exploring these ideas with you.
The takeaway for me is that successful investing is about so much more than just picking stocks.
Right.
It's about understanding those bigger forces at play, being strategic, being patient, and never stopping learning.
Couldn't have said it better myself. We've equipped our listeners with a powerful set of tools and insights, and now it's up to each of them to take this knowledge and chart their own course through the exciting world of investing.
Absolutely. So to all our listeners out there, thanks for joining us on this deep dive. Until next time, happy investing.